All right, again, welcome everyone. It is Tuesday, September 13th at a little bit after 2 o'clock. So we appreciate you coming in. We have a lot to talk about today. Just like we do always with the Retirees Association, today is going to be about a little bit of a market update. And it is also going to it's also going to cover the retirement plan changes that have just recently been announced at MSU. Now, I know there are some folks on the call today that are active employees. If you are an active employee, you received an email about this from MSU a week ago today, as a matter of fact. The folks that are separated and retired, you received a physical mailing on this, and from what we have understood, that the vast majority of them started hitting just in the last couple of days. I think Saturday was the day that a lot of people said that their documentation actually hit. So we're going to talk about this. And one more time, for those of you who have either attended one of the seminars that we have done over the past few days, or have watched the recorded session on our YouTube channel, when I start speaking in a little bit, it's going to be largely the same information. But before we get to that, we are going to do our normal market update piece. We won't go quite as long with that section as we normally do, because this is obviously a unique time, and a time that we want to make sure that people understand a few details about the retirement plan changes that are coming. Okay, so with that, we have a number of folks on here from StraightLine. You'll see some familiar faces. Jason Fisher's here, Mike Rice is here, Beth Mosshart is wandering around in the cyber universe. I think Amy Paisano, Doris Karras, Jason, I already mentioned Jason, Sonny Mera, Dennis Raffin from our team. Also, Steve Turry and I believe Mike Lasky are here from Skyview, our research partner. So Steve, are you out there? You might need to unmute yourself there.
Yes, hi. Good afternoon, everybody. Thanks, Mike.
Okay. All right, so what we're going to do today is really just kind of do this as a series of just questions that I'm going to ask and provide a little commentary along the way. But there are a couple of significant issues going on in the financial markets today. Anybody, and I mean today, literally and figuratively. Today has been a bit of a rough day with the inflation numbers that came out today. So I think we'll probably start there, but we're just going to do this as kind of a series of questions between Steve and myself. And then towards the end, I'll take over and talk a little bit more about the retirement plan changes. So I do not have I decided against putting a live shot of the market up at 2:11 p.m. Eastern time on the day today, but it's been a bit of a rough day. Nothing terribly different than what's happened up and down over the last few days, weeks, and months. But this one was really driven by the main subject that we were going to talk about anyway, and that is inflation measurements and the related impacts on things like interest rates. So Steve, I'm just going to leave it there and know that you know kind of where to, you know what's going on. So just we'd love to hear your thoughts on that part of it today.
Sure. Well, thank you. Thank you, everybody. And thank you, Mike, for inviting me to speak today. It's interesting. We always have these calls, these meetings, typically on the day of some kind of Fed announcement, and today is no different. Well, not today, announcement today, getting government data, and the inflation numbers came in worse than expected. So interest rates have gone up a lot in today as well as recently, and the stock market's selling off again because the markets are getting more concerned that inflation is going to be persistent for some period of time, and that the Federal Reserve is going to be very restrictive, or more restrictive, I think one of the recent pieces that Andy Melnick, our colleague, has put out, said, "Read my lips" from Powell, where they talk about, where Powell said there will be a restrictive policy for some time. And today's information only, confirms that, and we'll likely see a very restrictive policy in both the Fed funds rate increases, as well as what they call quantitative tightening, or a reduction of the Fed balance sheet, which also impacts economic activity, though we've never really done it before. So this will be a kind of a learning experience, and we'll have to see how the Fed handles that. So what the markets are dealing with is trying to figure out a balance between, on one hand, this inflation rising, and on the other hand, the Fed policies that will likely throw the economy in a recession. I apologize about the noise in the background. There's somebody cutting the lawn right outside my office window here, but sorry about that. So we are going to have to be dealing with that as participants in the market for some time. And there's dealing with the issues going on in the underlying economy, in that, we see inflation in a couple of areas. One area is the goods that we buy. So there we think those the inflation on goods is likely peaked and coming down. But the other thing we have to be concerned about is the inflation on services. And there, services are impacted a lot by employment and the cost of wages, wages increasing. And so we think the services inflation could be stickier and might be rising a little bit, or not peaking and coming down as quickly as the goods. So we look at a couple of other components, which is how many people are working. And we still have this negative demographic effect, really globally, but also in the U.S., where there's fewer people working. And that leads to a whole host of other economic issues that we could be dealing with, but the Fed is also trying to manage that, as well as concern about wage inflation. And with that, Mike, maybe I'll pause and see if you have any other questions or want to take it in a different direction.
Well, yes, I want just a couple of comments, really, that it's kind of interesting, and that right now it almost seems like the market keeps wanting to not believe Chairman Powell. And what we're really, I think, doing is the market's just trying to figure out, when things are going to turn. But, it struck us lately that, all of these things that keep quote unquote surprising the market really are nothing more than what he has been saying all along, that he's going to keep raising, the Fed will keep raising interest rates. I think, but the reason, or the fact that it keeps causing these shocks, even like today where the market's down a few hundred points, is almost kind of comical in a way. I know that that's a weird word to use because it's really impacting everything, but you can step back and say, this is exactly what he has been saying all along. And it's almost like the world just keeps wanting to not believe him and keeps being proven wrong. And the other thing, we're looking at inflation, as Steve said, energy prices have come down a bit, which has taken some of the pressure off. The goods inflation and the wage inflation is tricky. And I want to be clear about something, because this is not real happy news sometimes, or at least it doesn't sound that way, especially going into an election cycle. And we'll touch on that more in just a second. But why wage inflation is bad, right? What we always talk about as an economic factor, it's bad. Well, that doesn't really sound great as a humanitarian factor. Okay, well, why wouldn't we want people to make more money? The problem with that is that we do, of course, as human beings, we want people to be able to make more money. The problem, though, is if that comes and is consistent over time, what it leads to is more consistent inflation. And unfortunately, the pain of inflation is usually much worse than the growth in people's wages. So it's a net negative when we go down that way. So that's, you can tell that neither Steve nor myself are running for office right now, right? Because otherwise we wouldn't be talking about how wage growth is a bad thing. And again, I want to be very clear, it's not a bad thing in one sense, but as an economic indicator, it can lead to more problems. So anyway, that was just one clarification that I wanted to make. So taking off from that, Steve, we talked about energy prices. By the way, I should have said this at the beginning. The first few things that we're going to talk about are not going to sound particularly lovely when it comes to economics and market implications. But I promise you that we will bring it back with some thoughts about what we think is going on out there and where some opportunities still are. But as long as we're talking about not so wonderful things and mentioning energy prices, some of the news that's coming up right now about Europe and the problem of gas supplies and the fact that we are leaning into colder months, particularly in this hemisphere, and what is going on over there and what it could mean for Europe and international stocks in general. Love to hear your thoughts about that, Steve.
Sure, Mike, great point. We, as Mike might have indicated in some of Sunny and some of the other discussions, we are more positive on the U.S. than we are internationally, and particularly Europe. Europe is if we look at Europe in kind of two ways, there's the UK, maybe three ways. There's the UK, there's the rest of developed Europe, and then there's the developing parts of Europe. And the UK, while they're going through some pain right now, might be in a better position to come out of this. A lot of the other parts, particularly Germany, was very much dependent upon the globalization trade, or exporting a lot. And since there's slow global economic growth, that's going to impact them. And when Mike was indicating when we're coming into energy and in the winter, other than France, Europe is very dependent upon foreign sources of oil and natural gas. And if there's a cold winter, that there could be huge issues in different parts of Europe, in the sense that Russia might start playing more games on, might make it very difficult to get any kind of access to oil or natural gas, and to the extent that countries like Germany in particular need it. And so we're working on certain types of facilities to deal with liquefied natural gas, and some of those ports are getting open, but nowhere close to in time for this winter to meet the surging demand there in parts of Europe. So we look at Europe as having some difficult times ahead, particularly outside of the UK. UK is going through a lot of difficulties right now, but that might enable them to come out of it a little bit in better shape. So I think, Mike, is, based on that, as well as some of the issues going on, particularly in China, our view is to be overweight the U.S., particularly when it comes to equities, versus the rest of the world.
And we've been incorporating that into our management really for some time now in different ways. So I think the last main point on the investment side, and those of you who know StraightLine and Skyview know that we do not take political stances here. Okay, we don't get too deep into that world. However, almost everything that is done right now in terms of investment decisions has a political side to it, and you have to look at that. So some of you might have noticed that we are heading into an election cycle. You might have noticed an ad or two on TV or a sign or two here and there. We all know that there's going to be a whole lot more of them over the next 2 months or so. So Steve, and we have a lot that we've been talking about in terms of elections, and in no way are we talking about projecting election results. And to be clear, we're not talking about what we think should happen in any elections. We're talking about what is most likely to happen and what kind of market response we could expect from different types of transitions. So, Steve, if you could talk about that, maybe historically, the midterm elections after the balance of power switches between parties, and some of what we might be looking at on that side. I have a few thoughts of my own too.
Sure, it's a great point, Mike. Typically, as you indicated, that in the off-year elections, the party out of power, not in power in the White House, tends to gain in both the Senate and the House. What does that mean here is that if right now, if there's more gridlock, if the Republicans take over one or both of the houses, then there's less likely any kind of big economic packages or tax increases or whatever to get passed. Typically, the market looks at that favorably, but not always. And it also depends upon how the control changes. So I think maybe, Mike, what you were getting to is these off-year elections, what happens, midterm elections, what happens, and but in this case, really, if we look at inflation, gas prices have come down a lot. We track a lot of different things, and it's amazing how impactful the price of a gallon of gas has on how certain people vote and how people vote in general, sorry. And so, but the price of gas has come down pretty significantly in the last 6 months. We'll see where that goes, where that ends up as we come into election. I think there are more issues that people are dealing with from an economic perspective. One is inflation, the other is the potential for recession. And when we talk about recession, we're talking about unemployment. And right now, unemployment is very low and remains low. And that's a good thing from a political perspective. I think the Federal Reserve, even though they would like to see low unemployment, at the end of the day, higher unemployment will probably help curtail inflation than lower unemployment. So, looking at the midterm election, that's it seems like they appear to be a toss-up right now, Mike, and what the market impact is at, we'll have to see.
Yeah, and I'll just to add to that a little bit, Republicans will tell you that markets like Republicans. Democrats will tell you that markets like Democrats. History will tell you that markets like predictability to the best degree that it is possible, which is never really all that great. And so the best markets historically have come when one party is in the presidency and the opposite party is in power in Congress. Mathematically, that's just simple, verifiable fact. And it doesn't really matter. It doesn't really matter which one's on either side. And again, Steve mentioned gridlock, and that's an important word. Gridlock is not necessarily good for the world or for the country. Sometimes maybe it is. I don't, it depends on the situation. But gridlock is the highest degree of predictability that we can get from a political standpoint. So if we see Republican gains, doesn't take much, really, one net seat in the Senate or just a couple of net seats in the House. If we see Republican gains, it will most likely lead to more gridlock than we have. So markets do historically tend to like that a little bit more. It's not a guarantee, but those are very likely outcomes. Okay, maybe less likely than they were a few months ago. There's been a couple of pretty big political issues, as we all know, that have popped up, that have been dominating the headlines lately. And those are going to energize different groups of voters, perhaps in ways that wouldn't have happened before a few months ago. Time will tell. But this all ties together with, even the actions of the Fed. It's very likely that we will, the outlook for interest rate increases has been that they're going to do another couple. There's probably another big one coming next week, probably the same. Markets are telling us that it's most likely another 0.75%. As of this moment, that's still the most likely outcome. But it's also expected to kind of tone down as we get towards the end of the year and into next year. So we do, going back to something that we have said in the recent past, is that when it comes to those changes, we do believe that a lot of the damage is out there. It's known. We don't know if all the damage is done, but what we expect is just more of what we've had recently, which is a lot of volatility, not necessarily a ton of direction. So Steve, just to kind of wrap up this part, I know that there's always questions about, and we all have our thoughts on this, about investment conclusions from this, and what areas might we be favoring. You've already said that we've been moving away a bit from the international exposure, and we believe that that's going to be the trend going forward. But maybe if you could name an area or two, quality based, whatever it might be, that we're looking at as opportunities. Because one other thing before you go is, remember that the economy doesn't sound like it based on what's going on in the world and what we've said today, but the economy is actually still doing pretty well. It's one of the reasons why the Fed is able to do these things, because they're trying to slow it down a little bit to kind of arrest some of these inflationary things. So with that, Steve, are there other conclusions, other things that you're looking at, that we are looking at as a group, as opportunities out there?
Yeah, Mike, thanks. There are, as you mentioned too, on the equity side, focusing on higher quality companies that don't have a lot of debt that they need to pay back. Particularly, they need to pay back as interest rates are rising. So refinancing debt can become very difficult. So we're looking for those higher quality companies that can pass along the increase of some of their costs to clients and have the ability to grow coming out of it. And, those are sometimes they lag the market when the market's rallying big time. And, but we think over the longer term, that's a better way, both US and internationally, be positioned in the equities. And on the fixed income, it's a good time to be diversified in fixed income, but biasing towards the shorter term, of meaning less interest rate risk. Though you're getting rewarded a lot more today for taking that interest rate risk. So I think the great job that StraightLine did earlier this year, was reducing interest rate risk significantly, kind of still staying less interest rate risk, but moving back to closer to balance, but not exactly balanced on the fixed income side, would also, we think, be good at this time, because we're getting paid a lot more money for that than we were even 6 months ago.
Yeah. All right. Well, thank you, Steve. So at this point, that's roughly half of the time that we have allocated for today. So we're gonna shift a bit here, but before we do, does anybody have any questions? Also, you will have time for questions afterwards, and those questions can be about the market. They can be about the plan changes that I'm about to describe. But does anybody have any questions they'd like to go through now, either in the chat, or just feel free to unmute yourself and ask away.
Hi, Mike. I have a question. So you said that employees that are still working at Michigan State received a letter.
Well, some. I'm not sure that everybody has quite yet. Oh no, I'm sorry. You said employees that are still working.
Yes.
No, I'm sorry. The employees that are still working should have received an email. It should have been Tuesday afternoon, this past Tuesday, sometime around 2:30 or 3 o'clock.
Really? I don't know. I have to check my email, because that would have came from HR.
Yes. Yeah,
Yes,
yep.
since I requested a call back, I am now in the process of working on some of the items, so let me get my paperwork in front of me a moment.
All right, I think. we-
Okay, because I guess I have to look at my email because I don't recall getting anything from HR.
Okay, that's no problem. So actually, Jim, what you're about to see is a pretty detailed description of what that email said. Okay.
Okay,
So, but yeah, we can, and we can send you the official email. We have the text of it as well. So if you'd like to see that part of it, but, the presentation, I'm going to shift gears and jump into that presentation. And really the first slide of it is pretty much a shortened version of what that email said from HR. Okay. All right, so I'm going to shift gears here, and the back half of this presentation today will mainly be about this subject. So I'm going to share my screen with you here because I have a bit of a PowerPoint here to go through. So, all right, everybody see that? Okay. Okay, I saw a couple of people nodding, so thank you. All right, so on this one, and well, I think most of you know who I am, but again, I'm Mike Bassaro, and I've already kind of introduced you to the StraightLine team that's already on here, so we'll skip past that. So here is the yet quite consolidated slide that describes the piece that came from MSU, again, either in the mail or via email. Some of you may not, obviously some of you have not received it, but this is the main thing. So this slide really talks about why MSU is making these changes. Now, the purpose of this presentation today is really not to talk too much about why. Those are decisions that are made within the retirement committee at MSU with the help of their consultant. So this is about really more about how and when some of these changes are happening. And to be clear, before I even start, that's not to say that we disagree with them. That's not to say that we're passing judgment on them in any way. This is very much it's a very common step, something that we have dealt with across the state and across the country with different plans in higher ed over the last 8+ years. So really it's the next evolution of the plan change that happened back in 2012. So I'll talk about that more in just a second. So there are 3 main reasons why MSU is making this change. The first one has to do with the fees that you pay. And I say you because anyone who has any money in the MSU plan is paying an administrative fee, just like, and that's true across the board. Anyone in a 401k or a 403b plan, you are always paying a little sliver of a fee, hopefully a little sliver of a fee. And it is in this case for the operation of that plan. And the fees that are charged in the plan have evolved pretty significantly over the past 10 years or so. It started with the plan change back in 2012, and it's continued through the past few years. Some of you may have noticed about once per year there were fees that were refunded back into your account from TIAA or Fidelity. That is coming from the work of the Retirement Plan Committee. This is just the next step. So in a nutshell, you have always paid a very small percentage-based fee. This is not something that's easy to find. It's not on your statement. You have to really dig in there to go find it. That plan or that fee is changing to a flat dollar per head fee. Okay, so that's one. Number 2 is to move some legacy assets from the old plan and even from the current plans into a new structure. I'll talk about that more in a second. And for those of you at TIAA, it is another evolution of the contract structure within TIAA. Again, I'll talk more about that in a minute. One thing that is not changing for active employees is the contribution that MSU is making on your behalf. What MSU calls the base contribution, your 5 plus the university's 10%, is not changing. Now we know that it has changed over the past 2 years. It was reduced, and then it was restarted, and in some cases, and now even credited back. That was based on some COVID measures, and depending on the type of employee that you are and the groups that you were in, it happened at different times. But that is now restored, and that will continue on. Okay. So to discuss this change, it helps to go back to the change that occurred in 2012. So many of you remember, prior to 2012, there were 6 different companies to choose from when you were contributing to the MSU plan: TIAA, Fidelity, Vanguard, Lord Abbett, AXA, which is now Equitable, and AIG, which is now VALIC. So between those 6 providers, there were 587 investment options, which is an enormous amount to oversee, to choose between. So back in 2012, the plan was streamlined significantly. Now there are 2 providers, TIAA and Fidelity, and only 21 investment options between the 2 of them, most of which are identical. Okay. But in 2012, there was no requirement for any money to move from the old plan to what we have since called the new plan, really the current plans. That is the biggest change that is happening now. There's going to be some tweaks with the new plan on the TIAA side, but the biggest difference is that mutual fund-based assets that are currently in the pre-2012 plan will be moved. If you do nothing, it will be moved into the new/current plan over the course of the next few weeks and months. Okay. But it's mutual funds only, not annuities. Now, probably saying, well, what's the difference? I didn't know there were different types of investment options in the plan. And that would be very common. And for most purposes, there would be no reason to make a distinction between an investment option that is a mutual fund and one that is an annuity. However, there is a distinction, and in the case of the change that's about to happen, MSU has different types of authority on investments that are in mutual funds versus investments that are set up as annuities. Okay. One other thing about the word annuity. The word annuity can mean about a dozen different things in the financial services world. And so this is, again, this is a distinction that is very subtle in many ways, but it is also fairly significant. But it is not significant to the level of an entirely different type of account. Okay, so let me explain what I mean. For 5 out of the 6 legacy providers, this is really easy, okay? Because they're all mutual funds or they're all annuities. So if you have an account at Fidelity, whether it's pre-2012 or post-2012, if you have an account at Vanguard, or if you have an account at Lord Abbett, those are all mutual funds, meaning any assets in those accounts will be moving. And in those legacy pre-2012 accounts, those assets will be moving over the course of the next few months in a way that I will describe. Okay. If you have accounts at AXA/Equitable or AIG/VALIC, everything in those accounts are annuities, meaning the change that's about to happen will not impact those accounts in any way, right? So those 5, pretty straightforward. The one that's a little bit tricky is, in many ways, the most common one that is held, especially with folks who have been at MSU for a length of time or are retired from MSU, and that is TIAA. Within TIAA accounts, some of the investment options are set up as mutual funds, and some of them are actually set up as annuities. To repeat what I said a minute ago, for most purposes, this doesn't even make it, you wouldn't even make any difference. You wouldn't even know that they're set up differently, but they are. And here's why it's important. Again, the mutual fund assets will move. The annuity assets will not. So here's how you tell the difference. When you look at TIAA, the corporation itself for years has been named TIAA CREF, right? Many of you remember a few years ago, they rebranded themselves. They dropped CREF off of their corporate name, and the name of the company is now just TIAA. However, you still see TIAA CREF. If you look at your investment options that are there, if you look at the portfolio as you've invested in it, you see options that contain both names, TIAA CREF Large Cap Value Fund, for example. If you see both names on the name of the fund, it is a mutual fund, okay? If you see only one name, whether it's TIAA or CREF, like the CREF Stock Fund or the TIAA Real Estate Fund, or most famously and most commonly, the TIAA Traditional Fund, those are annuities. So if you have a pie chart, a portfolio made up of both of those things, and there are other mutual funds that contain other names like Western and all these other things. Anything that's in a mutual fund will move through this transition. Anything that is an annuity, unless you take action, will stay behind in its current contract. Okay. All right. So I'm going to summarize this on each of the providers. So if you have Fidelity, and you had contributions that went in before 2012 and after 2012, you have what we now call the new and old plan. The old plan will cease to exist as a part of this transition. Okay, the post 2012 plan is not changing. We've used the word new to describe it for the last 10 years. We will soon drop the word new, and the plan will just be the plan. But all of the assets that are in the old Fidelity plan will simply move to the current plan in the near future. Okay. The other thing that will happen, if you have the other two mutual fund-based options, Vanguard and Lord Abbett, and if no action is taken, sometime most likely early December, those assets will move into the current Fidelity plan. Okay, those are fairly straightforward. The other two that are straightforward again are AXA Equitable, AIG VALIC. Those options will not be affected. Those are all annuity options. Those stay the same. Okay. With TIA, here's a summary of what's about to happen. Now, there's one other thing. Again, this is a nerdy detail that most of the time has no real impact on you. But if you look close at the TIAA accounts, if you were to look at your statement, or if you go online and look at your account on their system, you will see typically numerous line items. Some people might have 2, some people might have 4 or 6 or even more. But those different line items are actually set up as different individual contracts within TIAA. And there are different styles. The pre-2012 has 2 different styles. The current plan has 2 different styles. There will be 2 new styles introduced here in the next few weeks. So anyone with a balance at TIAA, whether you are working or not, will have a couple of new line items that show up on your statement/website access. And they're going to contain the codes RC or RCP. RC stands for retirement choice. That's the base contract. RCP is the contract that will receive any current or old supplemental contributions, 403B, 457, whatever it might be. So all of those contracts are scheduled to appear in mid-October, okay? Sometime around October 15th-ish. For active employees, if you're paid every 2 weeks, your mid-October payment should go into the new contract. For monthly employees, your end of October contribution will be the first contribution to go into the new contracts. Sometime in the early phase of that, your balances in the current plan, the post 2012 plan that are in mutual funds, will move into the RC and RCP contracts. Okay. A little bit later in the year, most likely early December, your mutual fund balances in the pre-2012 contracts will move into the new RC and RCP. Okay. I know that I'm talking in alphabet soup right here, and I know this gets a little bit detailed and technical, but it's very important to understand these differences. Okay. For those of you working with StraightLine, we will handle all of these movements for you. But there are some quirks to this. There are some differences that apply to some people and not others. We don't have time to go through all of them today. One of the most significant is for people who have who have any money in the TIAA traditional fund in any of the current or legacy contracts. Depending on the style you have, depending on the way in which those contributions were made, there can be some differences as to how or if those assets will move or should move. Again, these are all things that we are equipped to handle for you, but there are some things that need to be discussed in some cases and some decisions that can be made. So TIAA is a little cloudy. It's a little tricky to understand all of these moving parts. And many of you are hearing these terms for the first times, base, supplemental, RC, RA, which I didn't even talk about, but that's the name of the legacy base contract. All of these little details here are very significant to this particular change. But again, don't lose any sleep over this. It's going to be happening over the course of the next few months. Some people will choose to intervene in these and perhaps create a different outcome. Some people will just allow them to happen and just take what is coming in that new plan. Again, this is not good versus bad. This is just different. Okay. And if you want a more specific description of this related just to you, we invite you to please call us, please talk to us, set up a meeting with us. I'll talk about how we can do that here in just a minute. Okay, so a couple of important considerations. If you are above or below age 59 and a half, and if you are still working or separated or retired, there are some different considerations to make during this transition. The group that has the least amount of flexibility with these upcoming changes are folks who are below 59 and a half and still working actively at MSU. If you're in that group, there's really very little that you can do to change much of what I have already said today. There are some tweaks that you can make perhaps, but for the most part, active employees below 59 and a half will more or less have to deal with these changes as they are laid out. If you are past age 59 and a half and or separated from the university in any way, then you do have a few more options. Doesn't mean you should necessarily change what's going to happen, but it's something that should be explored just a little bit further, perhaps. Okay. There is another thing that I want to make abundantly clear, and this is very significant for many of the people that are on this call today. If you have recurring distributions coming from one of these contracts, TIA, Fidelity, Vanguard, whatever it may be, whether it's a monthly draw or some other schedule, if you have recurring distributions, you want to give us a call. At some point in the next couple of months, depending on when these changes happen, it is very likely that your distributions from the account, I think I said contributions, forgive me, your distributions from the account will likely stop. Okay, that doesn't mean that you can't restart them, but it means that the action has to be taken to make sure they continue on. And the basic reason for that is because when you set up a distribution with Fidelity, and particularly with TIA, you're not really just setting it up with the company, meaning however the changes happen, they'll just keep flowing. You're setting it up based on the underlying contract that you have. So as these contracts switch around, again, especially at TIA, and money is moved between them, your instructions will not automatically transfer to the new buckets, okay? This is an easy fix, but it is a fix that has to be made for you to keep getting money, okay? So don't be scared, don't lose any sleep over this. You are not losing access to your money, but the instructions have to be updated once these plans change over. Okay, very important, particularly for folks who are retired, many of whom are taking these recurring distributions. Okay, so just very quickly, I know most of you on this call are familiar with StraightLine, but I just want to say a quick intro for anyone who is not. Just to remind you who we are a completely independent firm. We are not part of TIAA, we are not part of Fidelity or any other firm for that matter, or MSU. We are just here to help you manage your accounts, whether they are inside of the retirement plan, whether they are outside of the retirement plan, whether you choose to perhaps move money around between or out of the plans, to help with financial planning, to help with investment management, and to do this for you, okay? By the way, nothing that is going on will impact your ability to work with StraightLine. Okay, it's going to change the investment options that are available to you or to us by extension, but StraightLine will be able to continue working with you before, during, and after this entire process. Okay, so I've mentioned a couple times, come talk to us, set up a meeting with us. You can do that by calling our office, 877-338-4032, or emailing us at info@straightline.com. We have a YouTube channel now where this presentation will live, quite possibly as quickly as this afternoon, but certainly by tomorrow. We also, if you go to our website, which is straightline.com/MSU, first off, it'll look like that. And on here, you can see right here, there's a little button kind of on the lower right-hand side that says Book Now. Myself and all of the folks at StraightLine, Jason Fisher, Mike Rice, Beth Mosshart especially, we have a significant amount of time set aside over the next few weeks and months to meet with people both in person in East Lansing in our office there, or another location that works better for you, or to meet via Zoom or via phone. We know there's a lot of questions when these things comes up. We want to customize those answers for you. So you can go to straightline.com and book a time online right there, or just call the office and we'll get you set up. Okay, so with that, I know there are a couple of questions coming in on the chat. I'm going to open that up here for just a second here. Okay, so a few things. Does this just impact the MSU contribution or both the MSU and employee contributions? Good question. It impacts everything. It impacts any money that has been contributed to the plan. The changes that I have described are really based on where the money is held. The way that the contribution is made essentially has no bearing on the changes that are going to happen. So the only thing that determines whether money is going to move is essentially how it's invested. If it's in a mutual fund-based account, it's going to move. If it's in an annuity-based investment option, it will not move unless you intervene to make it move. Okay, so the type of contribution does not impact this process at all. Okay. The other question, I mentioned 59.5. The question is 59.5 as of what date? Good question. And the answer is basically now-ish, as of the date of these changes. So some of these changes will start in, in the next few weeks, really mid-October. So if you are above age 59 and a half by, say, early October, then your possibilities, whether you're working or not, do change a bit with these transitions. Okay. Couple of other things. A few people had to leave. Certainly understand that. Thank you all. This clarifies the letter that was sent. Thank you. I don't think there are any other written questions. Okay, does anybody have any questions they'd like to just pop out here? Just again, can unmute yourself and ask anything you'd like, whether it's about this change, whether it's about the market, anything else.
Yeah, I do. If I could, Mike, just for a second. This is Dave Wilson.
Yeah.
You said in the TIAA, you said that if it was a 2-word fund,
yeah,
that was a mutual fund and that will move, or do I have that wrong?
You have that correct. Yes, if it was, I'll go back to that slide here just to show you the example. So if you see both names, TIAA CREF large cap value, for example, if you see both names, it's a mutual fund. Okay, there's quite a few of them that contain both names, and there are mutual fund options that are not TIA CREF options. They're from other companies. Those are all mutual funds as well. Pretty much the only ones that are set up as annuities at TIA are the ones that really just the 3 main ones: CREF stock, TIAA real estate, and TIAA traditional. StraightLine team, I might be missing 1 or 2 others, but those very specifically, they only contain one name. Okay, so no, Dave, you said that perfectly.
Okay, thank you.
Yes, thank you. Does anybody else have any questions? Okay, if you missed anything on this, I know there was a lot of detail today. If these sessions today's session is going to be archived. You can go to our YouTube channel to see that. You will, every page on our website has that little that YouTube icon on there, and that will take you directly to our channel. You can sign up, you can register, subscribe to our YouTube channel, and then new content, you'll be notified of new content. By the way, the whole website's about to change a little bit. We have a new site that we're about to launch here probably in the next few weeks. So it's going to look a little bit different, but all of this functionality that I'm talking about, YouTube channel, all of those buttons will still be there. But this session will be archived. We have another session that's just a standalone session from a few days ago, just about the plan change. That'll be archived. We will also put together kind of a compilation of all the questions that we've been getting. This is the 5th time we've done this, so we're going to kind of lump all of the questions that have come in into one video and get that posted here in the near future. So a lot of material out there. You're going to hear from us again. You're going to get some stuff from TIAA in the future and Fidelity. So a lot of information that's coming about this. But at its core, there's really not a lot that has to be done, but we just want to make sure that everybody understands what this is going to look like and what your options will be. Okay. So anybody else, any other questions? Okay, well, hearing that or not hearing that, I will thank you all again. Appreciate your time today. And if anything else comes up, anything else that you'd like to ask individually, please give us a call. And of course, if you'd like to set up a time, please feel free, jump on in any of those ways, and we'll see you very soon. Thank you all very much.